There is a real worry as we go deeper into winter about what happens with the momentum that we built up through the summer. Let's just start there. President Mester, what do you see and where do you see deceleration that concerns you right now?
Well, there's no doubt about it that you said it well. There was a lot of momentum. In fact, the economy had come back stronger in the third quarter than many of us had thought it would. The economy just proved to be more resilient than we had thought. Disparate across sectors, certainly. Some sectors that really need that face-to-face kind of commerce are not doing well at all. Other sectors are back to their pre-pandemic levels or even beyond. I'm thinking autos, I'm thinking housing. So that disparity is troubling. We knew that things were going to slow down after the bounce back in the third quarter, and we're seeing that in the data now. I am concerned about the lack of fiscal policy. If you look back and to the beige book that we had going into the last FOMC meeting, and this is the compilation of all the contacts that we saw for prior to FOMC meetings, you'll see they had three concerns. One was what was going to happen to the virus in the fall. Two, who was going to be the next president of the United States, so election uncertainty. And three, what was going to happen with fiscal policy, because they were concerned without fiscal policy, things could get a lot worse. So one of those uncertainties has been resolved. The election uncertainty is resolved, but the virus case increase is very concerning. And the fact that we don't have a fiscal package is very concerning. So monetary policy, of course, has been, we've said we're using our tools. We're going to leave things very accommodative. We have interest rates at essentially zero. We have asset purchases, and we have our 13.3 facilities that are helping to get credit flowing to households and businesses. But with the disparate impact of this pandemic, that's where fiscal policy plays a role, because fiscal policy can be really targeted to households and small businesses that really need the aid, and to the states and local governments, which have taken on a lot of the burden here of helping. So I am concerned. Yesterday, we had our Community Advisory Council meeting, and these are representatives that are really on the ground in low and moderate income neighborhoods. And there's a real need for housing, affordable housing. Food security is an issue that's becoming a little more problematic as the fall has gone on. And the virus, the case numbers are troubling. So you see states putting on restrictions, and even without states doing it, you can see in the mobility data that we look at that people themselves are being more restrictive in their activity.
There doesn't seem to be any sign that Congress is going to do anything, at least in the short run here. So does that mean you need to act, you need to do something at the December 16th meeting?
Well, I think we're in a good place with our monetary policy because we are very accommodative. I think the need is going to be a fiscal response, because they need to be able to shore up the firms and the businesses that are really being hurt by the pandemic. And as I said, you can see some parts of the economy are doing very well, and yet there's a lot of people still out of work. We have 9 million people. We're not even back to where we were in February. So, that disparity really calls for a fiscal response. And if you look back at where we were at the start of this, the idea was to come in with strong fiscal policy, which happened, that CARES Act response, and with monetary policy, working in tandem, right, to try to get people through that period where the economy really had to shut down because of the surge in the virus, to make sure that we weren't overwhelming our medical system. We're kind of back to those levels now. I mean, a lot of the medical systems in different parts of the country now are really under a lot of stress. And the idea that we're asking people to make a sacrifice again and not having that aid in place, I think is going to be really burdensome on the economy going forward, and certainly burdensome on the families that are bearing the brunt of the small business owners we talk to, that are really, having to live now through some restrictions that they don't know whether they're going to come out at the end or whether they're going to have to shut down for good. And I think these things are related in the sense that if you are a small business owner or a person with a job that has to go into work, and you don't have that income security, right, it's hard to follow some of the restrictions. So, you may be taking a little more risk because I don't have a job if I don't go in. So I might have been exposed possibly to someone who had the virus. I'm not showing symptoms. I may go into work. Similarly, a small business, rather than, shutting down if there's a number of people who might have been exposed, they're going to try to stay open because they don't really have a choice in the sense that if they don't stay open, they're going to go out of business.
Well,
and so income support, I think, is needed for both to help them get through. But I also think it affects how well we are at following what the public health officials say are the right things to do to fight the virus. And I think that troubles me as well.
Well, that's all well and good, but Wall Street is looking at this and saying, well, we're not going to get anything out of Washington. So we need to get something out of the Fed. The yield curve is steepened a little bit. Maybe you need to term out your holdings on the balance sheet or maybe do a little more QE. Do you think either of those things are called for at the December meeting?
Well, I mean, I'm not going to prejudge the December meeting. We certainly, at every meeting we go in, we talk about where our policy is calibrated and what we need to do to make sure that we're adding accommodation and supporting the recovery. But again, you have to look across different sectors and sort of evaluate what tool can help the most to bring up the sectors that are, weakened in this and really affected by this. And it's not clear to me that monetary policy necessarily is the right tool to address those concerns. I grant you that, right now it looks like the fiscal authorities are not going to come in with another package. But you also have to think about what is the right tool to address this. And to my mind, when you have a disparate there's such disparity across sectors, it's the fiscal authorities and that fiscal policy that is the right tool to use to address these things. And so that's what's sort of the tension here, is that monetary policy is doing, I think, the right thing and keeping things very accommodative. Yeah. And yet we don't have the other side. And it's not an either or. Like, one can't substitute for the other, right? The reason it worked well in the beginning of the pandemic is they were working together. They weren't substitutes, they were reinforcing one another.
President Mester, one thing you could do, obviously, and I appreciate you're not here to prejudge the meeting, although we would love you to. One question that's been asked from people in fixed income markets at the moment is whether you would extend the average maturity of your bond buying. I don't expect you to give me a decision on that, but could you tell me if you see the benefits in doing something like that?
Well, I mean, as you know from the great financial crisis and the Great Recession, right, we went in and bought long-term assets to try to push down, right, the long end of the yield curve in terms of the yields there. And that's a tool of monetary policy. When we started the asset purchases in this environment, it was more about market dysfunction that we were seeing in the Treasury market and the mortgage-backed security market. So the actual catalyst was about that dysfunction. So we were buying across the curve. Of course, those purchases also added accommodation, so they had a twofold effect. But you're right in the sense that there are things like, looking at the maturities that we're buying, clarifying our forward guidance on the asset purchases can be helpful. I'm a fan of, as clear communications as we can make them. So that people understand our reaction function. So there are things like that that certainly would be under consideration. And that's going forward, we're going to have those discussions at our meetings.
Just because we're tight for time, is that something you would discuss at the next meeting? Because we do understand the reaction function around interest rates very clearly now. We don't on asset purchases. Is that something you need to clarify?
Well, I certainly am always a fan of clarifying our communications. And, at every meeting we talk about our communications. That's part of what comes out of the meeting, that statement that you see. So that's going to be a fundamental part of any FOMC meeting. And I can't, say what will come out of the meeting, but I do think that it is an important part of how are we communicating our policy to the markets and to the American public understand why we're taking the actions we're taking. And including all our tools.
You're doing a financial stability conference today. The last senior loan officer survey showed that banks were reporting weaker demand for business loans, and there were weaker demand and tighter standards for commercial real estate. Do we have a developing credit problem in this country?
I don't think so far, but I think that that's one of the things when you're thinking about a resilient financial system. It's twofold. It's obviously you don't want your banks to fail. You want them to be robust through economic downturns. But you also want the banks to be there lending through the downturn. And as you know, we took some actions early in the pandemic to try to ensure that the banks were there and able to lend to their customers and to households and businesses. So those actions were taken to ensure that credit could flow and that the banking system was an important way of getting that credit flowing. So, they're going to be looking, of course, at credit risk. And so far, what's been, I think, another strength of this economy is that losses and credit losses have not shown up at the banks as much as they might have. And so that's a positive in this economy, is that we don't see the kinds of things that we might have expected to see, given the shock and the deep shock the pandemic was. But we want to make sure that the financial system stays robust and resilient so that lending can continue to go.